Welcome to the Deep Dive, your essential briefing on what's moving the markets. Today, we're unpacking Stellar Bancorp Inc.'s Q2 2025 earnings call. Now, the market's initial reaction was, well, a bit of a head-scratcher. You have this EPS beat, but then a slight revenue miss left investors wondering, what's the real story here? But as we dug into the call, a much clearer picture emerged, and frankly, a more compelling one about how this regional player is navigating things.
Absolutely. It's more than just the numbers. What really stands out is the strategic clarity from management. They seem to be making some very calculated moves, especially around organic growth and, managing their capital carefully.
Sets them apart a bit.
It does. So we're going to dive into exactly what drove those figures and maybe what it signals for the rest of the year.
Okay, so let's get right to the headlines then, those initial puzzle pieces. Stellar Bancorp reported GAAP EPS, that's generally accepted accounting principles earnings per share, of 51 cents for Q2 2025.
Which was a solid beat. Consensus was $1.45.
Right, a 13.3% positive surprise. That definitely caught attention, gave the stock a little boost at the open.
But like you said, the top line was a slightly different story. Revenue, which is net interest income plus adjusted non-interest income, came in at $104.2 million.
Just shy of the $104.9 million consensus, so a tiny miss, 0.7%.
Yeah, and year over year, revenue was down about 2.5%. Oh. So you can see why the market might have been a bit conflicted initially, that mixed bag.
Definitely. But despite that slight revenue miss, the underlying profitability, the balance sheet metrics, they looked robust. Stellar delivered a strong tax-equivalent net interest margin, TENM, of 4.18%.
Which is good. And maybe more importantly, their core NIM.
Yeah, the core number.
Which strips out that purchase accounting accretion, the noise from past deals.
Gives you a cleaner view of lending profitability.
Exactly. That stood at a very healthy 3.95%.
And other metrics back that up. Return on average assets, ROAA, was 1.01%. Return on tangible common equity, ROTCE, impressive at 12.16%.
And the balance sheet looks rock solid. Total risk-based capital at 15.98%. Tangible book value per share, TBVPS, grew almost 11% year over year to $19.94.
Solid foundation there.
And if you're looking for stability, check the asset quality. Exceptionally strong. Non-performing assets were just 0.55% of total assets. Very low.
And charge-offs?
Minimal. Annualized net charge-offs at 0.01%. Basically nothing.
Wow. So credit is definitely not a concern here.
Not right now, no. It's a definite tailwind. On the funding side, deposits were up too. Healthy increase, $111 million quarter over quarter, reaching $8.67 billion.
And they were putting capital to work, buying back stock.
Yep, bought back about 791,000 shares, average price $26.08.
Okay, right. Let's move beyond those raw numbers then. Let's get into the how and why behind the quarter, try and solve that initial market puzzle. What really stood out was what CEO Paul Franklin called their originations momentum.
Yes, and what's really insightful here is how they're doing this when others are maybe pulling back a bit. New loan originations nearly doubled in Q2 compared to Q1.
Doubled.
Wow. Yeah, hit their highest level since 2022. So management is basically saying, look, this signals a strong return to organic growth. They originated $640 million in Q2.
That's significant.
It is. And they're betting big on Texas. They think this momentum, plus the resilient market there, and maybe a Houston tailwind from some government spending.
Right. They mentioned that.
Will keep driving loan and deposit growth through the second half of 25. It's a real double down on their home turf.
So if organic growth is priority number one, what does that really signal about their confidence and, where our money as potential investors is actually going?
Well, management was pretty clear on the pecking order. Organic growth first, then other strategic uses, and then share repurchases.
Which they said are graduated based on price.
Exactly. So buybacks are a tool, flexible but secondary to actually funding their own expansion. They see better returns in growing the core business right now.
Makes sense. Okay, this brings up the big question, though. Net interest margin, NI. Crucial for banks.
Always is.
Now, core NIM, excluding that acquisition noise, did dip slightly. 3.97% in Q1, down to 3.95% in Q2. Mostly higher funding costs, right?
That's the main driver, yeah. Costs are up across the board for banks.
But management sounds, pretty confident despite that dip.
They do. They talked about feeling good about defending and even incrementally improving what they called their top-tier margin profile.
So they think they can hold the line and maybe even push it up.
Yeah, intermediate-term goal is getting back to a 4% core margin.
Okay, hold on. Feel good is one thing. Core NIM dipped. Funding costs are still a pressure. Is that confidence, fully justified. What needs to go right for them?
That's fair. It's a challenge. But their confidence seems to come from two main things. First, their deposit strategy, which we should probably talk about next.
Okay.
And second, their view on interest rates. They think potential Fed cuts could lead to a more normal yield curve.
Ah, the steeper curve argument.
Right, where longer-term rates are higher than short-term ones again. They see that as structurally benefiting their NIM in the medium term, even if there's some noise short-term. They're positioning for that.
Okay, so you can't talk an M without talking funding. Where's the money coming from? CFO Paul Egges highlighted a really interesting shift in their deposit strategy.
Yeah, this was compelling. 50%, half of their net new deposit dollars in Q2 came from new customers.
That's a good sign, not just relying on existing clients paying more.
Exactly. And importantly, they're strategically using less FHLB borrowings. That's Federal Home Loan Bank money.
Which can be expensive.
Can be, yeah. And also fewer brokered CDs. Those are often higher costs too. They're actively shifting towards lower cost options, focusing on, as they put it, staying core.
Driving margin improvement from the funding side.
That's the plan. It's a proactive, disciplined approach to managing their funding mix.
And while they're investing in that growth, they're also keeping costs in check.
Seems so. Strong discipline on expenses. Non-interest expenses were basically flat, around $70 million.
Which they said was better than planned.
Right. So they're saying they'll hold the line where we can on general expenses. But that gives them room to be opportunistic in hiring talent.
Ah, okay. So save money here to spend it smartly there.
Exactly. Especially for C&I, commercial and industrial lending, and middle market teams. They feel the big infrastructure build, the back office build, is mostly done now that they're over $10 billion in assets.
So tighten the belt generally, but be ready to invest in people who can bring in business. Smart.
Seems like a good balance, yeah. Avoiding being penny wise and pound foolish.
Okay, beyond the core financials, couple of interesting strategic moves too. They officially became a Federal Reserve member back in April.
Right, April 14th. And that actually had a direct financial impact. Contributed $490,000 in Fed dividend income to non-interest income in Q2.
Free money, almost. Well, not free, but a direct benefit of membership.
Pretty much. And they also did that dual listing on NYSE Texas.
As a founding member, yeah. What's the thinking there?
Management sees it as reinforcing their Texas-centric brand, making it easier for Texas investors, maybe others too, to access their stock, leaning into that regional identity.
Makes sense for a Texas-focused bank. What about M&A? Mergers and acquisitions, always a topic for regionals.
Yeah, leadership acknowledged that conversations have kicked up a bit in their Texas markets.
Oh, so things are happening.
Sounds like it. But they immediately followed up by emphasizing a disciplined approach around pricing. They don't want to, quote, do any damage to the franchise.
Meaning don't overpay just to get a deal done?
Precisely. So cautious, but open. It's a nuanced stance. You wonder, though, in a consolidating industry, is being too disciplined on price risking missing out?
Always the balancing act.
For sure. They're clearly prioritizing the health of their current business over chasing deals at any cost right now.
Okay, so let's tie this all together. What does it mean for you, the investor, looking at this space? The market reaction on earnings day was interesting. Up initially, then closed slightly down.
Yeah, up about 1.6% at the open, then finished down 0.44% from the day before. It suggests investors like the EPS beat, clearly.
But then they started weighing that revenue miss and maybe digging into the Nyman trajectory, the funding costs.
Exactly, weighing it all against those strong fundamentals like capital and credit quality. It was a day of sort of nuanced digestion, a battle between the underlying story and those immediate sector pressures.
So how did the analysts react? Did they buy the underlying story?
Seems like it, mostly. We saw Piper Sandler raise its price target to $30, though kept it neutral. KBW raised its target to $32, kept it market perform.
And the reasons?
Both cited the stronger originations and solid credit.
So the overall vibe on the street seems to be, constructively bullish.
Meaning they believe the good stuff, loan growth, credit outweighs the immediate margin headwinds affecting the whole sector.
Pretty much, yeah.
Okay, so for folks tracking Stellar Bancorp, what are the key things to watch in the next few quarters? Got to be that loan and deposit growth actually showing up as promised for the second half, right? Absolutely. Execution versus those funding costs. That's critical. And the trend in that core, where does it go? Especially if the Fed does or doesn't cut rates. That'll be huge.
And keep an eye on capital deployment, too. How fast do they use that buyback authorization?
And do we see proof of those Houston market project wins they mentioned? validation of that specific tailwind.
Makes sense. And the broader context. Regional banks still facing headwinds.
Still grappling with funding cost competition, definitely. Though sentiment is improving a bit. You look at the KRE, the regional banking ETF, it actually have positive one-year returns now.
Oh, interesting. So maybe the worst is over for the sector sentiment.
Could be. And for Stellar specifically, their relationship banking strategy in Texas, that strong capital, clean asset quality, it positions them well. But, at the end of the day, sustained execution on that organic growth plan is going to be key for them to really stand out.
All right, this is the part of our deep dive where we put on our analyst hats, pitch some outrageous but plausible trade ideas, strictly for discussion, folks. Entertainment only. This is not financial advice.
Okay, all right. Given everything we just discussed about Stellar's Q2, here's a concept for the committee. Long Stel, short KRE.
Okay, betting on Stellar to outperform the group. What's the rationale?
It's pretty straightforward. Stel just reported its best loan originations since 2022. Signals a real return to organic growth. And they're doing it in a uniquely resilient market, Texas, with maybe some extra juice from those Houston projects.
Plus the funding shift and cost control.
Exactly. Aggressively cutting reliance on expensive wholesale funding, disciplined on expenses. And while the whole sector faces in pressure, Stel's management sounds confident about defending their margin, maybe even benefiting if the yield curve normalizes with Fed cuts.
And the clean balance sheet is the safety net.
That's the idea. So by going long Stel and shorting the broader KRE ETF, you're trying to isolate Stel's specific execution and strategic position. Betting its growth story will shine brighter than the general regional banking malaise. It's a bet on specific strategy and geography, not just the sector.
Interesting angle. Isolating the alpha, potentially, but again, just an idea, not advice.
Purely illustrative, yes.
Okay, that was a thorough exploration of Stellar Bancorp Inc.'s Q2 2025 earnings. We saw a company delivering that strong EPS beat, signaling good operational performance even with the slight revenue miss.
Yeah, and management's focus really came through. Accelerating organic loan growth, managing deposits strategically, keeping capital discipline, all within that vibrant Texas market. It feels like a clear playbook.
Absolutely. While the market had that mixed reaction on the day, the underlying health of the business, the strategic roadmap they laid out, it suggests a company really positioned for continued measured growth.
I agree. And their ability to defend that top-tier margin, especially if the yield curve cooperates eventually, that's definitely a narrative worth watching closely.
We hope this deep dive into Stellar Bancorp's earnings gave you some valuable insights. What details stood out to you? What questions does it raise? Maybe how much can that localized relationship approach really differentiate them when scale is often seen as king in banking? Lots to think about. We encourage you to keep learning and exploring.
And just remember, this discussion is purely for informational purposes. It does not constitute financial advice. Always do your own research and consult with a qualified professional before making any investment decisions.
Thank you for tuning in to the deep dive. We'll be back soon with another essential earnings call summary.